I want to start by saying there's a saying that when the US catches a cold or sneezes, the rest of the world has a flu. And it seems like the US is sneezing in rapid succession, and the rest of the world is trying to figure out how to deal with it. I want to start with you first, Deputy Managing Director, how you see this affecting the developing world in particular in a disproportionate way.
So, Lisa, I think that was an interesting introduction there. As any policymaker around the world, including central bankers, you want to have a projection, a forecast for what may occur in your economy, to employment, to inflation, to financial stability. And what's been clear over the last 2 days of our conversations is how difficult that is to make in this current environment because of very high levels of uncertainty and also some very big shifts in global trade policy. So I think there is a good question to step back and ask, how do you make policy in this very difficult environment? Now, for emerging and developing countries, and specifically for emerging markets, our expectation is that growth will be weaker by a 0.5 percentage point in 2025. Now, we've had fairly broad-based cuts to global growth. Of 127 countries, we have downgraded our growth forecast. That makes up about 86% of the world's GDP. But to capture this uncertainty, for the first time, the World Economic Outlook had what we call a reference scenario, as opposed to a baseline. Because while we have growth projected at 2.8% for the global economy for 2025, the probability that it can go under 2% has risen quite significantly over the last month or two. So again, to the question of what should emerging market policymakers, central bankers specifically, think about in this environment, you have to come up with a projection for what may happen to output, to inflation, and financial stability. In the near term, our best projection is that this will reduce output, but also be a disinflationary effect for your economies, because this shock turns out to work like a negative demand shock because of the elevated level of uncertainty and because of the hit to export incomes. And then there is the question of what may happen to your exchange rates and financial stability. And this time has been different because we have seen several currencies, including the currencies of Mexico and Poland, that have actually appreciated relative to the dollar, which is a unique occurrence in a risk-off time. So we haven't seen this big rush to the dollar that has happened in the past in risk-off episodes. So that means that emerging markets are dealing with actually much smaller currency movements than they've had to deal with in the past. And so even though financial conditions have tightened somewhat, and they have tightened for many countries, including with capital outflows, it's been mostly orderly, and we haven't seen a big tightening in financial conditions. So let's hope that we are past peak uncertainty and peak financial stress. But again, I think we should keep in mind, just like after the pandemic, it was a bit of a roller coaster. I expect that it will be somewhat of a roller coaster over the next months.